The previous video established what a budget is and why it matters. This video goes one level deeper and introduces two of the most widely used budgeting frameworks in personal finance. A framework is not a budget itself. It is a structure that tells you how to allocate your income across categories before you fill in the specific numbers. Having a framework removes a significant amount of the decision-making friction from the budgeting process. Because instead of starting from a blank page and trying to figure out what percentage of your income should go to rent versus food versus savings, you are working within a proven structure and adjusting it to fit your life. The two frameworks covered in this video are the 50-30-20 rule and zero-based budgeting. They represent two different philosophies about how detailed a budget needs to be effective, and understanding both will help you determine which approach is better suited to your situation. The 50-30-20 rule is a high-level budgeting framework that divides your after-tax income into three broad categories using percentage targets. 50% goes to needs, 30% goes to wants, 20% goes to savings and debt repayment. The appeal of this framework is its simplicity. Rather than tracking dozens of individual spending categories, you are working with three buckets, and the percentages give you an immediate sense of whether your spending in each area is proportionate or out of balance. The needs category, at 50% of after-tax income, covers everything that is essential to your basic functioning. Housing is the largest item in this category for most people, and financial guidance generally suggests that housing alone should not exceed 30% of gross income, though in high-cost cities this target is difficult to hit. Beyond housing, needs include utilities, groceries, transportation costs required to get to work, minimum debt payments, basic insurance premiums, and any other expenses that would have serious consequences if left unpaid. The critical distinction here is between needs and expenses that feel necessary. A streaming subscription does not belong in the needs category, even if you watch it every day. A gym membership does not belong in needs, even if you go regularly. The needs category is for expenses with genuine structural necessity, not habit or preference. The wants category at 30% covers everything that improves your quality of life, but is not essential to basic functioning. Dining out, entertainment, hobbies, travel, clothing beyond what is strictly necessary, upgraded versions of things you could get more cheaply, subscriptions, and discretionary personal spending all fall here. The 30% allocation is not permission to spend freely in this category without thought. It is a ceiling. If your want spending is consistently below 30%, that surplus can be redirected to the savings category. The wants category is where most budget overruns originate, and it is the most important area to track honestly. The savings and debt repayment category at 20% covers contributions to your emergency fund, retirement accounts, other savings goals, and any debt payments above the minimum. The reason debt repayment above the minimum belongs in this category rather than the needs category is that minimum payments are the floor, not the strategy. Paying only the minimum on debt is a needs-level behavior. Actively working to reduce and eliminate debt is a financial growth behavior, which is why it shares a category with savings and investing. To apply the 50-30-20 rule, start with your monthly after-tax income and calculate the $3 amounts that correspond to 50, 30, and 20%. Then compare those targets to your actual spending in each category. Most people find that their needs category is reasonably close to 50%, their want spending is over 30%, and their savings rate is below 20%. That pattern is common and not surprising given that want spending is the most discretionary and therefore the most susceptible to gradual increases over time. The adjustment process is identifying specific wants expenses that can be reduced to bring that category back within the 30% target and redirecting the difference to savings. The 50-30-20 rule works well for people who want a simple, low-maintenance budgeting framework that does not require detailed tracking of every transaction. Its weakness is that the broad categories can mask specific problems. Someone could be within their 30% wants target overall while significantly overspending in one area and underspending in another, and the high-level framework would not surface that. For people who want more precision or whose financial situation requires more careful management of specific spending areas, the second framework is better suited. Zero-based budgeting is a significantly more detailed approach. The core principle is that every dollar of your income is assigned a specific job before the month begins, so that when you subtract your total planned expenses and savings from your total income, the result is zero. Zero does not mean you have nothing left. It means every dollar has been deliberately allocated to something, whether that is a specific expense category, a savings goal, or a debt payment. Nothing is left in a vague, unassigned state where it tends to be spent without intention. To build a zero-based budget, start with your total expected after-tax income for the month. Then list every category of spending and saving that applies to your life, starting with fixed expenses like rent, insurance, and loan payments, moving through variable essentials like groceries, utilities, and transportation, then discretionary categories like dining out, entertainment, and personal spending, and ending with savings categories like emergency fund contributions, retirement contributions, and any specific savings goals. Assign a dollar amount to every category. When you add up all the assignments and subtract them from your income, you should arrive at zero. If the total is positive, meaning you have money left over after assigning everything, that surplus needs to be assigned somewhere. It does not get to float unallocated. You can put it toward an extra debt payment, increase a savings contribution, or create a buffer category. The point is that every dollar gets a destination. If the total is negative, meaning your planned spending exceeds your income, you need to reduce amounts in discretionary categories until the budget balances. This is where the exercise becomes most useful because it forces explicit trade-offs. You cannot overspend in every category simultaneously on a zero-based budget. When you run out of room, you have to make a decision about which category matters more. Zero-based budgeting is more labor-intensive than the 50-30-20 rule. It requires a more detailed initial setup, ongoing tracking to compare actual spending against the plan, and a monthly reset at the beginning of each period to build the next budget. Applications like INAB, which stands for You Need a Budget, are specifically designed around zero-based budgeting principles and automate much of the tracking work. For people who find that a high-level framework does not give them enough control or visibility into their finances, the added effort of zero-based budgeting tends to be worth it. One important concept within zero-based budgeting is the idea of a buffer or float category. Most people's income and expenses do not hit their accounts at perfectly synchronized times. Rent might be due on the 1st while your paycheck arrives on the 15th. Having a small buffer in your checking account means you are not scrambling to cover timing mismatches. In a zero-based budget, this buffer is an assigned category, not an accident. You deliberately allocate some amount to a buffer, and when it is used to cover timing gaps, it gets replenished in the next budget cycle. Choosing between these two frameworks is largely a matter of personal preference and the complexity of your financial situation. The 50-30-20 rule is better suited for people with relatively stable and uncomplicated finances who want a simple structure with minimal ongoing maintenance. Zero-based budgeting is better suited for people who want maximum control, are working to aggressively pay down debt or hit specific savings targets, have variable income that requires careful month-to-month planning, or have historically struggled to identify where their money is going. Neither is objectively superior. The best budget is the one you will actually use consistently. There is also nothing preventing you from using elements of both. Some people apply the 50-30-20 percentages as a high-level check on their finances while using a more granular category structure within each bucket. Others use zero-based budgeting for variable expenses while treating fixed expenses as a separate, static layer that does not change month to month. The frameworks are tools, and tools can be adapted. What matters is that you have a deliberate structure for your spending rather than an unexamined default. The final point worth making about budgeting frameworks is that neither of them works without honest numbers. The 50-30-20 rule does not tell you anything useful if you are misclassifying wants as needs to make the percentages look better. Zero-based budgeting does not work if you are assigning optimistic amounts to variable categories that you consistently exceed. The framework is only as useful as the accuracy of the information you put into it. Building a budget based on what you wish you spent rather than what you actually spend is a common error that produces a plan that looks good and predicts nothing. Start with your actual spending history, build the framework around honest numbers, and adjust from there.